Coming up today, stocks finish higher after a very volatile month, posting the largest reversal ever, holiday spending on track to hit record, income taxes could be eliminated, where Goldman Sachs says to invest next, silver rips higher, and a unique opportunity that may never happen again. The good times are back, guys. Let's go. And welcome back, guys, on this shortened trading day. Last day of the week, last day of the month of November, after the stock market was shut yesterday for Thanksgiving holiday. Hope all my American friends enjoyed their day off and woke up to some green in their portfolios today. After it's been quite the interesting month, sharp sell-off and just as sharp a recovery. It was a relatively subdued trading day to finish the month. We did see pretty good rips there in commodities, with silver leading the chart. I'll show you that on the charts later, along with a few other interesting things. So stick with me today, as I'm also going to show you what I think could be the best performing asset class of 2026, and this unique opportunity right now that may not ever happen again. I'll give you my exact reasons why, all backed up with data as usual. And so the story of this past week has been one of recovery, a market-wide rally. We can see that in the S&P 500 equal weighted index. Unlike the normal S&P 500 that's heavily concentrated in the Mag 7 stocks, this one weights all 500 stocks equally, so we can get a better look at market breadth and how the average stock is performing. And so it was this candle here last Thursday that really shook out a lot of people, convinced many that the rally was over. And then the very next day we did this big bearish to bullish flip. You can see my momentum upward thrust signal indicator fired off, and it's been pretty much up and to the right ever since, surprising a lot of people out there, but not all of us. As it was an ugly November, we were on track to have the worst month since 2008, especially looking underneath the hood of the market, not just the main indices. Many growth-sensitive sectors and stocks selling off hard on elevated pessimism and fear, which, believe it or not, still exists even after this sharp rally. Fear and greed index still in the extreme fear zone, and we just got the latest AAII investor sentiment survey. Still overwhelmingly more bears out there than bulls. More people think the stock market will be lower in 6 months from now. And it's data from that survey that was used to compile this chart here, showing just what an unusual year it's actually been. Pretty much unlike any other year. Normally, when markets are rallying like they are, people are generally bullish and positive, as we can see in the diamonds here. The difference between the bulls and bears, looking at the investor sentiment survey. And you'll see that generally correlates with the bars, the S&P 500 return for that year. But this year, the market's positive, but there's still, on average, way more bears than bull. Many people are very skeptical on this entire bull market and what's driving it, including the current admin and the boom in artificial intelligence, led by a massive capex spending cycle, making one of the most vocal bears, Michael Burry, super popular. After disclosing down his hedge fund, he's launched a bearish investing newsletter over on Substack. Well timing it on last Thursday, right as fears were hitting peaks. But now we've seen the largest swing ever from red to green for the month of November. The 4.5% point swing from November 20 to Black Friday is the largest ever for any November. And that's actually been spurred on by heavy institutional and hedge fund buying, actually looking to take advantage of the dip, something we haven't seen from them in quite a few months. And with that is coming some good technical signals. When markets go from being sharply sold off to then staging a good, strong bounce across the board, that can typically produce really good forward returns looking out 6 to 12 months. We've almost triggered the swag breadth thrust, which basically shows a lot of people selling stock too quickly, a lot of people buying stock. And we're on the cusp of the Whaley breadth thrust as well. And when both of these technical signals occur within 1 week of each other, the forward returns are super strong. Higher 6 months later, 100% of the time, with an average 20% gain, and a year later, 28.6% average gain. That is huge, pretty much triple the average year. And I saw that in my own indicator as well. My S&P 500 oscillator, which looks at market internals, went into oversold conditions on that Thursday, and that was really the first time, the height of the tariff tantrum back in early April, that this unique indicator of mine had gotten to the oversold level. But now it's quickly bounced back, and the S&P 500 is within an inch of hitting new all-time highs. And this is generally a bullish seasonal period for stock. Black Friday through to about February or March, especially when there's already a bit of price and earnings momentum in the market like we've got now, and coming off technically oversold levels. But it's not just the charts that look good, it's the fundamentals as well. Like I've been saying for quite a few months now, consumer spending still holding up really good. In fact, US consumers are on their way to hit a new record, with the National Retail Federation forecasting the first ever $1 trillion holiday season. And that's Thanksgiving through to the end of the year, with a notable and massive increase in AI-driven e-commerce traffic coming from chatbots to retail sites, up 725% from last year, which definitely flies in the face of all the bears claiming that AI is one big bubble that some said last week had already burst because stocks were selling off. But the fact is, this bull market is still young, only 3 years old. Looking at the prior internet boom, bull market lasted 12 years. Nothing to say this AI boom can't go on for another 9 years, because it's not just the AI revolution helping to unlock massive productivity and profit gain for companies big and small, but also there are other structural reasons supporting the stock market. Huge amount of share buybacks with cashed up companies, record participation of people buying stocks, but also on top of that record demand for stocks, there's also decreasing supply. Number of public companies is actually falling pretty steadily ever since peaking out in the late 90s. There's been a lot of mergers and acquisitions, fewer companies going public, and of course larger companies becoming more dominant. Along with them buying back their shares means an ever decreasing supply, relatively speaking, to history and the demand for shares out there. Also, just looking at equity risk premium, which I would say is one of the best valuation measures, because it's not just looking at an absolute number in a vacuum, but rather a normalized earnings yield versus the real risk-free rate adjusting for inflation. And that's still positive, even with the big indices sitting at highs. Of course, they're not cheap, but they're nowhere near as expensive as the late 90s either, when ERP actually went negative. And this is a key indicator that it would take for me to at least get neutral or not so bullish, especially on the big indices. But just a few days ago, we got the launch of the Genesis mission. I think could be part of the bounce back in stocks. It's going to unlock a torrent of political, regulatory, and liquidity tailwind, not just for AI stocks, but for a number of satellite industries as well. Energy being a big one, which is the real bottleneck to AI's growth. And now we just heard the president make a big bold claim that income taxes could be eliminated in the coming years due to tariff, which if true is giga bullish for the economy and the stock market. As we've already seen, tariffs don't increase inflation. They've actually just increased revenue for the government, giving them more option, and why I think we're more likely to see fiscal stimulus next year. Government on track to collect a little more than $400 billion in fiscal 2026. Still a ways off what's collected in individual income tax at $2.6 trillion. So it would be very ambitious to close that gap within a couple of years, but even income taxes are not eliminated completely, but can be reduced. That's a further structural tailwind for the stock market. In addition to likely tariff dividend check going to be sent out to Americans next year. A lot of that will not only boost consumer spending, but also find its way into the stock market, all supportive of premium valuation. And we literally just heard from the president today saying he's determined to keep the stock market at all-time highs, which is not something you usually hear from a president, and that implies a strong Trump put option, because if the market does sell off hard, him and his team are going to pull out all the stop to juice it back up. And so I agree with Ed Yardeni, who's been right for many years now. The roaring 20s are still well in play here. I agree with him that we're on track for a strong 2026. We're going to see further productivity gain, resilient consumer demand, a lot of earnings growth momentum, more advances in biotech, robotics, and AI, and US GDP growth that could actually start trending towards a forehand. And like Goldman Sachs, as we've seen, a broadening stock market rally this week, not just the Mag 7 going up, but rather pretty much the entire market in every sector. I think the best opportunity going into 2026, and in fact going into 2030, will be small cap, just as Goldman has listed as their number one recommendation. We also heard from Tom Lee as well, getting super bullish on small caps. And a lot of people don't realize they're also going to benefit huge productivity gains being unlocked by artificial intelligence. But I honestly believe small caps will be the best performing asset class of 2026, and like I said, potentially for several more years yet going into the 2030s. And this unique opportunity right now may not ever happen again. And let me give you 4 solid reasons why. The first being, Wall Street analysts are forecasting massive growth for the Russell 2000 small cap index next year. 42%, far greater than the S&P 500, even the NASDAQ 100, mega cap tech company. And that growth is set to kick off in the first quarter next year. Looking at the S&P 600 small cap index, that's set to overtake earnings growth in large cap for the first time in many years, starting next quarter. And this comes at a time when we've got a record earnings gap between large caps, especially the Mag 7, and small caps. The forward PE on small caps as of today is 15.2. And to translate that into a forward earnings yield, you take 100, divide that by 15.2, that equals 6.57% earnings yield, which you could kind of think of as what investors get paid to invest in small caps. At a time when short-term bonds are yielding almost half of that, 3.49% on the US government bond 2-year yield. So you can lend your money to the government and they'll pay you 3.49% per year for the next 2 years. Or an investment in small cap stocks, yes, definitely with some more short-term volatility, but you're likely to earn almost double that per year over the next 2 years. And so we've never seen such a massive mismatch between small cap and large cap earnings growth and valuations at the same time. I think we could see this massive alligator jaws gap close very sharply, because on top of huge forecasted earnings growth for small caps over the coming years, the massive divergence with large cap valuations, we've also got the high likelihood of lower interest rate, even starting next month. 86% chance the Fed cuts rates next month, and especially after we get a new Fed chair in May next year. Interest rates could very well surprise on the downside along with inflation. Nothing to say we can't be at 2.5% by this time next year. And again, that's massively bullish for small cap stocks. They love interest rate cuts. Looking back in history, they significantly outperform large cap stocks as they're much more sensitive to the cost of capital. And so that was my third reason. After earnings growth, the valuation gap, rates coming down. My fourth reason why I think small caps are on the verge of outperforming next year and potentially for several more years to come is they've only just broken out of a 5-year consolidation. Literally last month, we took out the November 2021 highs. Very bullish signal, sitting at all-time highs. Chart to my eye here looks very good. In fact, we've got what's known as a cup and a handle formation, which looking back in history is one of the most bullish technical formations you can ever see. And you just compare that to the chart of the NASDAQ, which has had a fantastic run over these last 5 years. In fact, it's actually tripled as the Mag 7 have been dominating the headlines along with their earnings growth in that time. But just like I showed you, that is all set to change starting next quarter. Small caps are set to grow earnings a lot faster than large caps, even the NASDAQ that we're looking at here. And just looking at a spread chart of the Russell 2000 small cap index versus the Magnificent 7 ETF mag, we can see small caps have been underperforming mega cap tech stocks for several years now. But last month, we got a really important candle here, a hammer formation where it sells off, then rallies back to highs on big volume. And when you see that at lows, it can often mean a bottom has been put in, the market's found support. Also interesting to note, coming at the same time where this downtrend may have just been broken even this month. The relative value of small cap and mega cap tech stocks may have just changed, technically speaking, starting to front run the fundamental differences we're likely to see next year. And just looking at the weekly chart of the Russell 2000, we had 4 consecutive down weeks and a big green candle this week. In fact, the biggest we've seen in quite a few months, finishing up over 5.5%. And it's for these 4 reasons I think small caps offer the most compelling opportunity going into next year after they've been massively underperforming for many years now, heavily ignored, record low positioning as well. A lot of people giving up on them, but cycles always turn. Nothing stays the same forever. Small caps are right now pretty much the deepest valuation discount relative to the S&P 500 and NASDAQ in history. Huge earnings growth forecast next year. Super favorable macro environment. Lower rates on the way. Very supportive admin of domestic companies. Reshoring manufacturing. Prospect of lower tax rates. Increased stimulus. Liquidity on the rise. A new Fed chair. This all adds up to being very bullish for small cap stocks. And so as retail investors like you and I are, how do we take advantage of this? Well, I for one am literally buying a new small cap stock every week. In fact, I've created a whole service dedicated to capture this opportunity in its entirety, as I believe small caps could outperform going into the year 2030 and beyond. And so I run a weekly stock pick service. I send out a deep dive report every Sunday morning. And here's an example of the report I sent out last Sunday, letting my 500 plus members from all across the world know that I was about to buy Cypher Mining the next day, a crypto mining stock, also renting out their massive compute power for AI services as well. I think they're one of the best crypto miners out there. And so in every weekly report, I explain in plain English exactly what the company does, a link to their website, a link to their latest investor presentation. I give several bullet points for why I like them, all explained in simple terms. I show what their latest numbers are. I give some technical analysis of the chart, also mentioning risks, and then giving my bullish thesis summary of why I'm going to invest in them the next day with my own money. And as I explained to my members on Sunday, there was a big pullback in crypto stocks, which I thought was a great opportunity to buy the dip, just like we did, and the stock's already up over 40% this week, helping to drive a monster gain for my stock picks portfolio this week. Only a couple of $1,000s off all-time highs. And you can see all my brokerage records uploaded into the private members area, with links to all 36 of my current picks that I've got open. I buy a new stock every Monday. Anytime I sell a stock, the proceeds are reinvested equally into all positions at the first of every month. It's a great strategy that compounds wealth over time. And even though I truly believe we're on the cusp of a small cap super cycle, my stock picks portfolio is already significantly outperforming the Vanguard small cap index fund by a factor of 2.5 since starting last year. And so I started this account with $500 last year. My goal is to turn it into $1 million within the next 8 years, which I'm on track to achieve. And so if all that makes sense to you and you want to jump on board and be a part of this journey, wherever you are in the world, whether you're a new investor or an experienced investor, you're welcome to join my stock pick service, as now is the best opportunity to do so, not only in the market, but also before our Cyber Week sale ends this weekend. You can lock in a 30% discount off a monthly plan or just pay a one-time lifetime fee by using promo code BTFD30 at checkout. Just click the link below this video and head on over to my website, clickcapital.io, and join my stock pick service today, as I truly believe this is just the beginning of a multi-year monster bull run for small cap stocks, when mega cap tech could actually consolidate or not perform as well as it has done these last few years. And unlike anybody else out there, I actually put my money where my mouth is. So my interests are perfectly aligned with all my clients. So if you don't want to miss out on that, now's your last chance to jump on board today. Click the link below this video and use code BTFD30 at checkout to secure your spot today. And just moving on, looking at what else is moving out there. Oil is on track to post its largest yearly decline since the pandemic. The world's flush with supply, and this admin's been achieving their objective of keeping the price of oil low, boosting domestic supply, and potentially with the likely end of the Russia-Ukraine war soon, it's possible part of that deal we see increased supply from Russia, which holds some of the largest oil reserves in the world. And so that's the benefit for them, as they get to sell more oil, come back into global trade, and along with growth and usage of renewable energy significantly outstripping growth in oil demand. That's another structural headwind for the price of oil, which is great for the economy as a lot of it still runs on oil. So the cheaper it is to travel and move goods around, that just greases the wheels of the economy and by extension the stock market as well. And so who knows, we could see crude go down into the 40s, even the 30s dollar per barrel over the coming, which again will help inflation come down as well. A commodity likely to perform much better is one that's actually needed for the electrification of the world. Silver, they're finding more and more ways to use it, not just in solar panels, but in batteries and potentially robotics as well. And that commodity is for sure in a strong bull market. It's got a momentum upward thrust signal on my indicator here today, breaking out to brand new all-time highs, $57 an ounce. As my regular viewers know, I've been very bullish on silver all year. And in fact, we've got a couple of silver stocks in our picks portfolio, helping to drive gains today as well. We also saw a little bit of a bounce in uranium, still quite a little bit off highs, but I'm still as bullish as ever, as I have been for a couple of years. And platinum as well, which we've actually got in our ETF portfolio, had a monster day, up 6.2%, and even natty gas having a multi-month breakout there today. Just moving on to crypto, having one of the worst months in a long time. Bitcoin falling 35% off highs, whilst the fundamentals have never been better. A huge disconnect and divergence with other risk-on assets like the Nasdaq not too far off highs. On some measures, we saw a record washout and liquidation of crypto traders. We were hitting records and elevated fear reading. And last week, on the 21st of November, the price actually got down to $80,000 a coin. You can see my reversal signals indicator telling us this down move may have gotten exhausted. We've seen a bit of a bounce here on low volatility and low volume. We haven't seen that big face ripper of a day, Bitcoin and other growth assets yet. So we could potentially get a retest next week, maybe form a double bottom. We already look like we're setting up for a bullish divergence here in my DSI indicator. So I wouldn't be surprised if that happens. No doubt another red candle or two will rile up the bears, but I believe that will be another buy the dip opportunity. Going into the bullish seasonal period, along with rumors floating around, we could be on the cusp of seeing a US national Bitcoin reserve over the coming months. I think it would be a smart move for the US government to buy the dip in Bitcoin, especially if it went back down to $80,000 a coin. As over the last couple of days, we've seen the odds increase dramatically here on Polymarket. That's going to happen. Keep in mind, insider trading is inevitable. The president's team has hundreds of people, admin, juniors, analysts, where information is always likely to leak out first by somebody. Just takes one person telling a friend, neighbor, or a cousin, and the market can move. And so I expect this to happen in the coming months as well. We're already just seeing Texas buy $10 million worth of Bitcoin for their strategic reserve. I think the US government is next. In addition to further deregulation, crypto market structure bill, and more Wall Street and institutions adopting crypto and looking to move their transactions onto the blockchain and tokenize real-world asset, which is even more bullish for Ethereum than Bitcoin, in my opinion. Bitcoin's like gold, Ethereum's like oil, has a lot more utility. And just like in stocks, we've seen significant big money buying this dip in Bitcoin and crypto during the sell-off. It's been a bit of a retail washout. But like I've been saying all year, I believe this admin is going to run it hot, and with hitting budget surpluses, price of oil staying low, artificial intelligence unlocking productivity gains, I think they've got the room to do so. The market and earnings at all-time highs, rates on the way down. I don't think it's any surprise to see a big bounce back in small caps relative to large caps this week, and I believe this is just the beginning of a small cap super cycle. And if you'd like to join me on this exciting journey we have ahead of us, then click the link below this video, head on over to my website, clickcapital.io, and jump on board my stock pick service. that focuses specifically on investing in small cap stocks every week with full accountability and transparency from me, as this is your last chance to do so. With the Cyber Week sale ending this weekend, I'm also taking Monday off, so by the time I'll be back, your opportunity to save 30% will be gone. So click the link below this video and use promo code BTFD30 at checkout and jump on board my stock pick service or grab a package deal if you want to get even bigger savings on multiple services. That's all for this week. Have a great weekend, and I look forward to seeing you inside the members area soon. Cheers.